You're listening to the Allan Gray podcast. I am Voyam Khotliso, a manager in the product development team at Allan Gray, and your host for this episode. As we head into the last quarter of the great election year, we thought it would be an apt time to reflect and explore some of the key themes currently shaping financial markets, which include expectations about global inflation and interest rates, the election outcomes to date, and their anticipated impact on the direction of economic policies globally, and closer to home, South Africa's macroeconomic environment and our outlook given our recently formed Government of National Unity. To unpack these themes, I am joined by portfolio managers Sean Munzi and Talia Patusi. Sean manages portions of the stable and balanced fixed interest portfolios. He is also the manager of the optimal portfolio. Talia manages the money market and bond portfolios, as well as portions of the balanced fixed interest and the Africa fixed interest portfolios. Sean and Talia are also the co-managers of the newly launched Allan Gray Interest and the Allan Gray Income Funds. So Sean and Talia, you have each hosted episodes of this podcast, but neither of you have been on the other side of the table, or the hot seat, as some like to call it. So Talia, how did you end up pursuing a career in asset management?
To be honest, I think when I was at Varsity, I wasn't completely clear on what I wanted to do, but I knew it was going to be something using numeracy and maths. So some of it was kismet. I think when I finished my honours degree, I was interviewing around and, working in a bank seemed like it would give you broad exposure to a few areas of finance. And I ended up having some really interesting conversations with one of the bank's fixed interest trading desks. And that's where I started out. So yeah, a bit of planning, a bit of kismet at the end. And then the move later on to the buy side felt really natural.
And Sean, you celebrated a decade with Allan Gray last year. What has kept you here?
I think the thing that initially attracted me to the role was that it's very details focused. You can take your time to gain a very deep understanding of the area that you're covering, and the team sort of allows you that space to do that, and also the flexibility to think around a subject matter and sort of approach it from a very different direction. So I think it's quite a dual nature of the role where you can be very stuck in the detail, but also if you do have a bit of a wider perspective, it can really help whatever investment recommendations you may favor. And I think as you progress in the role and start managing money, you're able to marry those two concepts quite nicely in the way you construct a portfolio on behalf of your clients. So I've been now with Allan Gray for about 11 years or so. I must say, when I first joined in 2013, we were coming off the back of a decade of very strong equity returns in the South African market. The decade that I've been in the team, perhaps less so, but who knows? Over the last sort of 2-3 months, we've seen an extremely strong rally in the bond market. So yes. I've got to stick around at least till we see another equity bull market at some point.
Thanks to you both. Now that we know a bit more about our subject matter experts, I think it's a good time to kick off. I thought to start with something that is top of mind for a lot of our clients, and that is South Africa's Government of National Unity, which we are a couple of months into now. So the centrist coalition government was widely embraced by financial markets in mid-June, with the Rand, the JSE All-Share Index, as well as the bond market all experiencing substantial gains. So Talia, in your view, could this be Ramaphoria 2.0, or is the investor confidence in the potential for economic reforms and stability warranted this time around?
I mean, if we look back on the period following Ramaphoria, kind of in 2017 and then 2018, the big disappointment was, it wasn't accompanied by any policy changes. It certainly wasn't accompanied by any economic growth. In fact, the period that followed saw substantial economic deterioration, and that was after a multi-year period of decline that came before it. in terms of, degradation of state-owned entities, of local municipal balance sheets. I would say an erosion of South Africa's institutional strength. And then certainly playing catch-up in terms of the outcome of a lack of infrastructure maintenance, which had been happening for years, in particular, I guess, in the energy and water space. So, what could be different this time? Well, firstly, prior to the Government of National Unity, so the GNU being formed, Eskom was already on a bit of a turnaround. I think of the turnaround as being a result of, firstly, the debt bailout. Okay, so a lot of debt was transferred onto government's balance sheets. They got 254 billion rand of debt relief. They'd also fixed up some of the very important Kusile units that have gone offline as a result of that chimney duct collapse in 2022 that contributed to 2 stages of load shedding. And then the third very important part was, allowing private sector their own unrestrained generation capacity. So we saw a lot of relief coming through as the private sector installed solar panels on their roofs, etc. So just even as a result of Eskom's turnaround, those 3 points that I alluded to, everyone is broadly expecting economic growth to kind of bounce back in the next year. But when I say bounce back, this is off obviously a very depressed level. And keep in mind, people measure GDP growth. It's a year-on-year calculation. So obviously your base, matters a lot. Sure. So maybe after a few years at running at 0.5%, the expectation is next year, could come out at 2% real GDP growth. So in excess of inflation or slightly higher. And then in terms of policy stepping further in the right direction. So, already, the change in terms of energy reform has been positive, but I do think the GNU could lead to, further steps in the right direction. We're really starting to see green shoots of that. And it's really because I think it introduces some competition between parties. So we're already seeing parties and different ministers trying to showcase their capabilities to the populace. And we haven't had that in the past. We've had the ANC in a very firm majority. And at times, it really felt that they weren't trying. Now, I think initially I was also quite concerned, and Sean and I actually had a lot of discussions around this in the kind of early days as the GNU was still being grappled out. I think we were both concerned that the DA and the other coalition parties would be given the trappings of office, but be politically neutralized in some way. And we saw that even in the initial grumblings and arguments in that the DA had put forward that they wanted to be able to vet their own director generals for different departments. So it wasn't good enough for them just to have the ministerial position. They wanted to know that they could have some say in terms of the key people who were going to execute on the mandate of the department. So that's one thing I think we were concerned about, and that we still, it remains to be seen how, things hang together on that front. And then just in terms of challenges, even some DA ministers have been quite transparent. For example, Siviwe Gwarube, who's, our new Minister of Education, she has said, a challenge that she faces is that, the Education Department has a massive budget. It's 300 billion rand per annum, but 80% of that automatically flows through her department and then gets transferred to provinces. And they really ultimately decide how money is spent. Okay, she is, laying out a guideline, but the implementation rests with them. So, I've heard her argue that the issue of why, pit latrine toilets haven't been eradicated yet in South Africa is not actually a budget problem. It's around the execution of local government and the provinces. So that's one thing we are watching, I would say. And then, another department, for example, where the DA is Minister of, communication and digital technologies, there as well, we see a similar kind of theme where 60% of the budget automatically flows through to the 11 odd SOEs falling under that entity. So this is SOEs like the SABC, the SA Post Office. And I think it's clear, some of the grants that are being funneled through there are going to waste. We know SA Post Office is essentially in business rescue. So some of these entities, I think there are some diamonds within that kind of group, but some are certainly bloated, uncompetitive entities. So I think we can expect more than the post-Ramaphosa period, but how much is still up for debate. So, for example, Department of Transport, a really key department. I think there, if Transnet takes, 12 years to turn around rail, that's going to be a major impediment to economic growth going forward. There's a lot of CapEx projects that still needed to be executed on. So, Eskom is a good example. They need to lay out 15,000 kilometers of transmission cable. And to do that, it's going to require a lot of international funding. And luckily, there are some international funding partners who are willing to put out the capital, but many of them have already said they require government guarantees. So that then creates a contingent liability on South African government's balance sheet. And we've seen, I guess, the negative effects of that, via even the Eskom bailout. That was a contingent liability for a while until it ultimately came home to roost. And then just one more thing, some of this rally in bonds in particular was a result of certainly the formation of a GNU, but I'd say an equally big part was JAFECRA. So that is, the monetization of, our gold and FX reserves. We have 1.2 trillion odd. And essentially, we printed some rands against this account. So we didn't go and sell our FX reserves, but we just printed some rands against that account. And there's been 100 billion rand as a result that has, as of end August, already flowed through to the fiscus, so through to government for spending. And just to contextualize that 100 billion rand, since that 100 billion rand has been distributed into government accounts, it means that in August, government was running a cash balance of 140 billion rand. Okay, now that is tiny. I mean, that means, excluding JAFECRA, if JAFECRA hadn't happened, they would run 40 billion rand. Now, that is the lowest level of cash that we've run, South African government on record in nominal terms. So in 1985, government ran the fiscus with an 80 billion rand cash buffer. Now, you can't really run a 7 trillion rand economy with a 40 billion cash buffer. It doesn't allow you any kind of spending leg room. So it sort of becomes clear that if it wasn't for JAFECRA, government would have needed to raise debt issuance, and certainly that would have been very negative for bonds. So I think in terms of what happens from here, equally as important as the outcome of the GNU, and again, maybe the two are tied together, is the trajectory of spending. So there's no shortage of state-owned entities and municipalities going to Treasury for handouts, but I guess we need to see government and Treasury hold the line in a way that hasn't been held in the last several years. And again, in part, I'm not trying to place the blame on Treasury. It's in large part due to just the state of the economy and the demands that were being placed upon them.
To add one thing there, we're currently reaping the benefits of this change in sentiment, which has been big, and I don't think we should discount that. And then I think the JAFECRA was a nice little bump on top of that. Yes. Plus, as Talia mentioned, the sort of rebound of Eskom, which was a massive headwind to the economy. Put those things together, perhaps it's sufficient to boost your GDP growth by perhaps 100 basis points, maybe slightly more, and gets us into that sort of 1 to 2% category, which is a lot better than the sort of 0.5 we were running for the longest of time.
Agreed.
But I think our doubts on the fiscal trajectory of South Africa still remain. And for that, you have to both maintain sort of robust reins on the spending side of the equation, but we really need a change in trajectory on the economic growth side, and how that then feeds into the revenue running to central government. And I think that's where it's still too soon to tell. One, and I'm not too sure whether the ruling party has fully internalized the election outcome. Yes. The overarching policies remain pretty much similar. Yes, one or two departments perhaps will be more efficiently run, but the idea of sort of state-led growth, developmental state, is very much sort of front and center. For us to unlock growth sort of in excess of 2, closer to that sort of 3, 4, 5, dare I say 5% range, which really changes the lives of ordinary South Africans, I think we probably still have to bridge that gap. And the concern for me perhaps is that election cycles can be quite short, particularly when you overlay the sort of ANC election cycle over the top of it. So I guess a poor outcome for the country would be, after we've got this next sort of lease on life, would be that actually everyone sort of hunkers down and focuses on what the outcome of the next ANC presidential race would be, because you almost get another chance at it in the 2029 general election. So I think those are some of the signs that we would be looking out for, where we say actually the country's trajectory has gone onto a different plane, and that can make actually sort of a sustained long-term benefit for the fiscus and for the country as a whole.
I mean, I think I do want to know then from you, what do you think will unlock that economic growth for South Africa? What changes do we need to see that are not tailwinds, as you've explained? What's going to lead to sustainable economic growth?
I think people can't even sort of dare to dream what actual pro-market friendly, pro-economic growth friendly policies might even look like. So as soon as you even start to throw things out of sort of widespread privatization, people can't even imagine that. But actually, there are a lot of countries that have gone through similar processes in the past and been much better for it. So I guess a good example now is Transnet. They're making some encouraging signs about introducing private operators into some of the ports, particularly in our most important port in Durban. But it's taking a long time, and it does feel like with all these things, often the devil's in the detail. We need to see how much flexibility the private port operator has, say, for instance, when it comes to how it deals with labor, for instance. A lot of metrics out there saying that Transnet, Eskom, name the SOE, is very labor heavy and could be run a lot more efficiently. So I guess privatization would be on one side.
Sure.
A rethink of how South Africa deals with labor relations is another one. We speak to a lot of management teams in South Africa, and South Africa is a tough place to operate with in terms of labor, and for good reason. I guess that's just where the ruling party had its roots in the unionist movement, and you can see that expressed in our labor laws. But I guess one of Mr. Ramaphosa's key pledges is to unlock investment in South Africa.
Sure.
And for that, you probably need perhaps more labor-friendly market practices. And I guess the other thing that you hear day in and day out is that getting a handle on crime and corruption and resetting the perception of South Africa in the international market. That actually, for companies to invest here and take a multi-decade view on SA, I think you probably need to restore a bit of faith in that regard too.
No, I do think it's going to be a difficult feat, especially when we've got parties that have quite opposing ideologies. I don't foresee that being an easy road ahead for us. So the ANC lost its outright majority for the first time since 1994, but this isn't the only dramatic election that we've seen out of this year. A key trend that we are seeing globally is that incumbents are typically not doing great. Examples beyond South Africa include India, France, the European Parliament, and the United Kingdom, where we saw the Labour Party win by a landslide, breaking 14 years of Conservative rule. By and large, it seems like people are generally unhappy with their governments, or at least not as happy as they were 10, 20, or even 30 years ago. So, Sean, in your view, what is driving this trend?
It's an interesting one, and I can't help but think this is probably the first election cycle that we've gone through once all the countries dealt with the COVID years, which I think have had an impact on the way sort of the public and voters see and interact with their governments. As you mentioned, there's been quite big election results. Some you probably could have seen beforehand, and others have been a bit more surprising. I guess the UK is an interesting example, just because the incumbents, the Tories, had been in power for a long time already, sort of more than a decade. And say, for instance, the UK economic growth has been rather stagnant for the best part of sort of 8-9 years post-Brexit. You throw a sort of a big inflationary cycle on the top of that, which I don't think a lot of the public had seen. And I mean, the last big one in the UK was in the 70s. You live through this cycle now where you have prices for some categories running at or above double digits for sort of 2 years running. I think that totally reframes the way people view the government.
Sure.
And it's almost, particularly if they think the government is sort of partly to blame. So I guess when you've got a economic growth slowing, plus things getting more expensive, doesn't make the best sort of election platform
Agreed.
for politicians.
So are you saying this is more because of economic pressures?
And that's the sort of traditional school of thought, that actually both emerging markets and developed market countries, people place their intentions, desires, goals at the forefront of their minds.
Sure.
And the economy is the sum total of all of those. So you would think that if an economy is doing well, growing at a decent clip, then that should lay the platform for politicians to do well in the polls. And to some extent, what you've probably seen is almost a protest vote from the electorate saying, actually, we're not happy with the way things are run. I guess there is potential for voters to change the course of how the country runs and operates via the ballot box.
Sure.
Sometimes it does feel that actually, when you boil it down, a lot of the politicians run actually very similar policies.
Yes.
And actually, maybe you just had enough of this lot and you rather just give the other lot a go and see how they progress. The one thing just on this, I guess, which was quite interesting on the SA elections was that disappointingly, it looks like our electorate is losing faith in the democratic process, which I think is something that we should be worried about.
Yes.
It was our lowest election turnout ever at 59%. And if you think of the period that South Africa's been through over the last sort of 5 to 10 years, if anything, you would have expected a much higher voter turnout. So I think that is something to be concerned about, because that's a form of a protest vote in and of itself, actually just staying away, because you've almost lost any faith in the process and any hope in the future.
So sticking with the theme of elections, the United States, Kamala Harris and Donald Trump are ramping up their efforts to return to the White House. And the polls seem pretty tight, with Kamala currently maintaining a narrow lead over Donald Trump. Talia, how should investors think about the upcoming US elections? In the event of a Trump victory in November, do we expect to see net negative or net positive spillover effects to emerging markets such as South Africa?
I mean, for me, what's most interesting about the US election is actually that neither candidate, so Kamala Harris or Donald Trump, and neither party is planning to rein in the deficit. That's completely off the radar. I mean, the US is running a historically wide deficits for peacetime period and historically high debt to GDP for peacetime period. So debt to GDP has breached, the 100% of debt to GDP kind of threshold, but they're still running this, 6% wide deficit. And if you look at the policies of either candidate, so in Kamala Harris's case, it's really, a continuation of what I think of as the ironically named Inflation Reduction Act, which really, what it does is it boosts spending.
Yes.
And if you look at her latest economic plan, actually it adds about $2 trillion to the deficit over a multi-year period. And that is even if, she were to raise corporate tax in the US from current 21% to 28%. So that's quite something. And certainly I think a lot of that could be very inflationary. So, underpinning her economic plan, one of the items that she has in place is to give first-time home buyers $25,000 towards down payments on mortgages. So, that's almost, in rand terms, 500,000 rand, just to orient it for South African listeners. Yeah. But really, with demand for homes in the US still outstripping supply, I think, putting extra cash of this kind into the market may actually just translate into higher prices.
Sure.
And then if you flip to the other side and look at Trump's policies, certainly, there's not the expectation that corporate tax would be raised. In fact, he's been speaking to lower capital gains tax. But that in itself is not helpful to the deficit either. So really, gone are the days of, if I think of, the 1990s period where the Clinton administration was trying to narrow the deficit, rein in spending. I mean, they did that by reducing military spend and so on. I think now, and maybe this speaks to what you were discussing with Sean around, incumbents losing their position, more and more, I think parties are leaning on more populist measures to try to attract the vote. And then something else quite key around, Trump's plans is, he said he wants to impose very large trade tariffs or import tariffs on China. He said 60%. Now, I mean, already, there are pretty large tariffs on China, from the US and from other developed nations. I think the US has just increased the import tariff on Chinese steel by another 25%, or they're planning to. And then Trump has also said he wants 10% blanket tariffs elsewhere, so excluding China. So China is obviously being faced with, the most punitive or severe tariffs because what it has been doing, and again, this has been a trend for a while, is really overproducing in multiple sectors and then dumping, their surplus products into international markets at ultra low prices that, in fact, local manufacturers cannot compete with. So, I mean, what have they been producing a lot of? Many things. So they've been exporting a lot of steel. They've been overproducing battery electric vehicles. We've seen dumping in their own markets. Something like solar panels. I read recently, in the space of 2 years, they produced enough solar panels to satisfy more than 100% of global demand.
Sure.
So, and I mean, they're not the only, country in the world producing solar panels. What is the outcome of imposing large tariffs on, I guess, multiple countries, because this wouldn't just apply to China, is it probably leads to higher inflation. And again, so the theme being higher inflation, I think, potentially as a result of Trump's policies or Kamala Harris's policies. And really, that has, I think, a negative net translation to emerging markets. And then also by neither party really making any move to try to narrow the deficit, I think that also has a negative net translation to emerging markets because it means that there's automatically scarcity of capital with which to fund emerging and frontier markets because more capital is being, sucked out of the offshore savings pool to fund their own large deficits, ergo less capital available to flow to the periphery. And often people benchmark off kind of the heyday when, SA government's debt was 40% held by foreigners. This was around the 2018 period. I mean, that was a period when a lot of capital was flowing from offshore, in part also because rates were very low. They were essentially for the space of a decade, flirted with 0% for much of that time. Net, either candidate has the potential to actually, ironically, even though they're, on this fight against inflation, to contribute to high inflation, scarcity of capital, which does have some negative translation to EMs.
So are we expecting higher inflation for longer periods of time? Analysts have been talking about inflation cooling, both in South Africa as well as abroad. Is this not the expectation?
Yeah, so certainly, I mean, keep in mind also, as I mentioned with GDP earlier, I mean, inflation is a year-on-year calculation.
Yes.
So we're coming off some really high base years, when, the oil price was as high as, $120 a barrel, back in 2022. As a function of the fact that it's year-on-year, there are a few items, actually many items in the basket that are now disinflating off that really high base. But to separate out kind of the short-term call from the longer-term call, for me, I still think longer term, structurally, over the next decade, we see higher inflation than what we did over the last decade. And again, that doesn't mean we return to, the US's, 7% average inflation, over the 2022 period. But it means, instead of running maybe a 2% Fed target, that actually, we run at, 3%, somewhere around there, maybe even 3.5%.
And at home, I mean, we've also heard here that the Reserve Bank market expects for the interest rate cutting cycle to start as early as mid-September. What are your views on this? Are you expecting a 25 basis point cut like most analysts are expecting, or are you expecting something bigger?
As we sit here and record, we haven't had our September MPC meeting, nor has the Fed has its meeting. Yeah, I mean, I think there is room to lower rates, both abroad and locally. Again, separating out kind of a short-term call from a longer-term call. For me, what's more important than, how much they do at a single meeting, the market's so obsessed with how much will they do in the September meeting. I'm more interested in the terminal rate. So where do we land?
Sure.
In let's say a year to 2 years' time, what's our new terminal and is that a sustainable rate? And there, I think, our South African Reserve Bank, Governor Lesetja Kganyago, and in fact, many of the members of the MPC, they've been pretty conservative. And I think they've been pretty understanding that, you can't fix, for example, SA's growth rate with as blunt an instrument as, the overnight rate of interest. You can't fix our growth rate with that.
Sure.
So you're not going to go and suddenly, let's say they were to take the overnight repo rate from 8.25% and drop it down 200 basis points overnight. You're not going to fix unemployment. You're not going to fix, our structural shortage of energy, or, you're not going to fix Transnet rail issues, et cetera, et cetera. So really, I guess their task is to try to set some sort of level where you get a good balance and really where you make sure that inflation doesn't run away rampant, essentially. And they target, the midpoints of the inflation band of 3% to 6%, so 4.5%. And historically, they've alluded to the fact that, 2.5% real rates seems reasonable to them. So that would put us at a terminal 7% overnight rate from 8.25% now. And broadly, I think that's where the market is pricing for the terminal rate to be, is somewhere around that 7% level, which is actually slightly higher than pre-COVID. So 2019, we were at 6.75% at a point in time. Yeah, so it seems like a reasonable terminal rate. I'm still, though, in terms of my longer term view for inflation being perhaps structurally high in the past, and we can chat on some of those structural reasons. I'm sure Sean would love to as well. Partly as a result, actually, of wider fiscal deficits, higher government debt globally. As I said, you suck out capital out of the savings pool. You also put pressure on rates when you do something like that. When you spend a lot, again, by the Inflation Reduction Act, this big drive offshore and developed markets to try to rebuild local manufacturing capacity, you put pressure on inflation and ergo on rates, as we try to transition, towards renewable energy and decarbonize, initially there's a lot of spending that needs to take place there. That can also be quite inflationary, especially if we are initially, far less efficient than what we were before.
Sure.
So there are a few structural reasons. And then, if I kind of translate that to the SA landscape, we have the added issue that, our administered price inflation remains high. So that's, electricity, water, rates and taxes, etc. And that, I think, feels pretty structural because it speaks to, our structural shortage and our structural underspend in terms of capital expenditure.
Talia mentioned the terminal rate for SA, and I think that's a lively debate on what the appropriate terminal rate is for the US. And it feels like the consensus is actually inflation, although it was persistent in nature. It was sort of, rather than taking a few months to normalize, it took a few years, but actually we would probably trend back to the environment that prevailed for the majority of the 2010s, when you had that sort of 1.5% to 2% price level. Our working assumption is actually that maybe that 1.5% to 2% is probably on the low side.
Sure.
And it doesn't have to be that sort of 7% that Talia alluded to earlier. But what happens if inflation does settle in the US at sort of in and around that 2.5%, 3% to 3.5% level? I think that's very different from where the market is currently pricing sort of longer-term break-even inflation numbers. Because there's an argument that says actually, yes, people are clamoring for the Fed to start cutting rates, and everyone's saying they're so far behind the ECB, the Bank of England, the Swiss National Bank. Everyone's well in front of them. But I guess the difference there is actually in a lot of those regions and economies, actually you've seen quite sluggish economic growth. In the US, it's very different. The economy has been growing despite these very high rates. And if you look at some of the other indicators, sort of house prices are at all-time highs. The stock market is at all-time highs. Food prices are at all-time highs. Yes, I get it's a year-on-year phenomenon in inflation, but we haven't seen much deflation outside of the energy basket. I think there is that argument that actually perhaps monetary policy has less impact on inflation than it thinks it might. But at its very worst, it shouldn't be inflationary by itself.
Sure.
And I think there perhaps could be elements there that actually, if the Fed does cut to the degree that the market is anticipating, sort of, I think it's about 230 basis points over the next sort of 12 months or so, you combine that with a view that actually inflation over the next sort of 3 to 5 years might be structurally higher than what prevailed in the 2010s, you do get, I guess, into that territory where perhaps it creates its own sort of inflationary loop on the back of that. And I think that's sort of together with some of those longer-term structural trends that Talia mentioned earlier, be it sort of demographics and debt, deglobalization going hand in hand with sort of increased defense spending, plus all the sort of efforts to decarbonize and what that means for the inflationary basket.
I mean, a lot of the excitement or the exuberance around this kind of pretty deep US rate cutting cycle that's being priced in is off the back of, well, what I think of as, so-called weak labor market data that's coming through.
Yes.
I mean, just to contextualize that weak US labor market data, I mean, unemployment has ticked up to 4%, okay? So that means there are about 7.1 million unemployed people in the US right now today. Now, against that, job openings have fallen, but I mean, they've fallen to, I think the last print we have was 7.7 million. So, I mean, that's still pretty good. I mean, it doesn't mean that there's going to be a perfect match between those who are unemployed and the actual job listings that are out there.
Sure.
But still, that's 7.7 million is actually still high versus history. And then, on top of that, in the last 3 years, the US has actually seen record population growth. So the population has expanded by about 9 million people over the last 3 years. So that's about 1% per annum. And that's the highest rate that they've had in 20 years. Now, why? It's certainly not because of new births. So new births are I think they're about a third of what they were 20 years ago. It's because of higher migration. So, I mean, you take a look at that all in totality.
Yes.
They added 9 million people to the economy.
Yes.
They have 7 million unemployed and they have 7.7 million job listings. Yeah, I mean, everything is kind of coming down a bit from kind of the record job listings we had, post-COVID. But still, it's, to me, I struggle to get behind, a weak labor market narrative at this point. And I think a lot of the argument now is, it's this SARM rule in economics, which is essentially that if you have a change in the unemployment rate of 0.5% or more over a 3-month period, you're headed for recession. And it's based on, what's happened, throughout history.
Sure.
And you don't necessarily have to be able to explain it with any kind of fundamental driver. That's just, the rule. And recently the US did hit that 0.5%. And I mean, to me, what kind of muddies the waters a bit is if you're adding a lot of people to your population very quickly, you can't necessarily compare it to the period of 10 years ago, 20 years ago, when you weren't adding that many people.
Yes.
So you're not comparing kind of a like-for-like scenario. If suddenly, let's say you had 10% population growth and the employment rate rose by 0.6%, I mean, that would be a great outcome, So those are some of the vagaries of the US data that Sean and I discuss and sometimes scratch our heads over.
And what are your thoughts there with regards to Trump in particular and his policies that he wants to put in place?
Yeah, I mean, so not all of it has been illegal immigration. So there is still a healthy level of I guess, legal, immigration that's taking place. But yeah, I mean, that's certainly been something he's been, campaigning with.
Yes.
Strengthening the border, etc. I mean, it's become a hot topic across a few developed markets. And I tend to think, this kind of swing to the right that we saw in some of the election cycles. I would even argue in the UK you saw it, despite the Labour Party win. A big reason why they won is because the Conservative Party lost a lot of market share to Reform UK. And Reform UK were definitely campaigning with a very strong anti-immigration kind of sentiment. I mean, here in SA, even our Patriotic Alliance, they were, at a point in time saying, and they did make big market share gains, actually, considering, where they were beforehand. They were also campaigning with a policy that they were unplug the life support from non-South Africans in government hospitals, etc. So, what that does to immigration in the US is, I guess, another question mark, spanner in the works. In some way to now, depending on the type of worker who's coming in, it can be really positive, because in the US and in a lot of developed markets, they struggle with a shortage of unskilled labor.
Yes.
So the exact opposite of our economy.
The point could be that actually over this period, when you did see heightened inflation, the level of migration into the US took the worst of the pressures off on the wage front, which I guess was dissimilar to certain European countries that saw sort of 2 years in a row of double-digit wage inflation.
Sure.
The US wasn't at that type of level, so I guess that's helped in that regard.
So we've spoken at length about the global macroeconomic landscape. And as I briefly mentioned earlier, at Allan Gray, we've recently launched 2 new funds that take a lot of what we've spoken about into consideration. So Sean, can you please take us through the investment mandates and the objectives of the 2 new funds?
Yeah, so I think it's quite an exciting time for Allan Gray. And I think the last time we launched a standalone fund in the South African market outside of our sort of tax-free offerings was sort of in the mid-2000s with the Allan Gray Bond Fund.
Yes.
A lot of the feedback we've been getting from clients over the last little while is that they see a place for the money market fund and the bond fund within their investment portfolios. But when they look at our low-risk offering, they can see a gap within our fund range. And previously, I think the stable fund fitted quite nicely into that bucket. But we recognize that the last 10 years, as I mentioned right at the start, haven't been great for equity returns. You've generated a similar return profile as if you would have been in an income fund type category.
Yes.
When we went through this process, we saw that actually an interest fund that is more in the sort of enhanced cash profile, so like our money market fund, but slightly longer duration and confined to domestic assets only,
Sure.
could fulfill a similar role to the existing money market fund as a building block portfolio, sort of a place where people can park cash for a short period of time and earn returns above sort of traditional money market fund category, but not taking on any additional credit risk with very low volatility. And then together that, launching the Allan Gray Income Fund in the South African multi-asset income category, where we take on slightly longer duration, but not anything too drastic, and perhaps portfolio fit also, again, for a client that's looking for a building block type solution as part of a wider South African asset portfolio, can generate returns ahead of money market and the sort of enhanced cash options.
Sure.
At quite low volatility. So we've put it there in the fund objective, minimizing the risk of capital loss over any sort of 1 or 2 year period. So I think when you look at our fixed income fund range in terms of the sort of return versus volatility matrix, you would have our money market fund on the bottom end and the bond fund on the top end, which I guess represents our highest conviction bond views, and then the interest fund and the income fund slotting between those two options and available to clients to meet their own specific requirements and needs. While the interest and income fund will fulfill their roles as part of a building block solution for our clients, we still think that the Allan Gray Stable Fund provides the best risk-adjusted returns for clients, given its ability to flex its asset allocation and invest in growth-generating equities.
Given that we were talking about disinflation, well, in the short term at least, the expected interest rate cuts and the general uncertainty around economic policy. Talia, how are these new funds positioned?
They're structured in a way so that they have very low interest rate sensitivity, so modified duration risk is very low. Now, in order to achieve that, kind of the bread and butter, of such funds is floating rate instruments that will then earn cash plus a specific spread. And, generally every quarter they're resetting back to the rate of cash. So in an interest rate hiking cycle, you're incrementally earning more as you follow the cash cycle higher. As, rate cuts materialize, you earn slightly less essentially with rate cuts that come through. But that is really the biggest part of any of these funds is floating rate instruments with very low interest rate sensitivity. So you're constantly resetting to the cycle. Now, obviously, these funds still have a component of fixed rate paper. You can put inflation-linked paper in there, structured notes, and, our job is also to alter that asset allocation mix. So when we first launched the fund, or these funds, there wasn't very much of an interest rate cutting cycle being priced in at all.
Sure.
So we held much more fixed rate paper than what we do now that the market has priced that cutting cycle in. So at the fund's inception, we held a lot of 5-year fixed rate money market instruments at 10% yield, which we felt was a really nice base layer to have in there. Maybe the income fund, which is, got slightly higher risk appetite than the interest fund. It also had some structured products at about just above 12% interest rate, also fixed rate. But then as, the market has adjusted to now price in interest rate cuts, that's already now priced into the fixed rate yields that one earns. So, in that move, we've taken profit on some of that paper. We've increased some of the floating rate exposure that we have. Really, I mean, at any point in time, we're trying to construct portfolios, and this applies to the interest and income category, that will do well in multiple scenarios. So we still have our core view about where we think things are headed in terms of inflation and interest rates, but we don't put all of our eggs in one basket. We're trying to think about, cash plus returns and a return profile that will do well in a range of scenarios.
So in closing, with so much uncertainty in the current environment, do you have any parting words of wisdom for our listeners?
My closing thought would be, actually, while it can be hard to stomach, volatility can actually be your friend. We saw that during COVID, where actually that was the right time to stick with your financial plans and financial goals and not become too risk averse at exactly the wrong point in the cycle.
Sure.
And I guess that's our job as the investment team at Allan Gray, is that we can adjust the funds dynamically to take advantage of this volatility and cheaper asset prices in order to generate decent returns for our clients.
Sean's given such a nice full-bodied answer. I mean, I think I'll just echo that, the environment is never certain. It's never been certain, but, that's part of our job, is to, as I said, construct portfolios that do well in multiple scenarios and think about those risks.
Thanks again, Sean and Talia, for joining me and sharing your insights. In a world filled with concerning headlines, we understand that it is hard not to panic and make rash decisions driven by emotion. While the future is always uncertain, as long-term oriented contrarian investors, we always focus on the fundamentals. We encourage our clients to focus on their long-term financial plans and goals rather than reacting to short-term market events. If you'd like to get in touch, please send an email to info@allangray.co.za. You can subscribe to this podcast on your preferred platform to be notified of new episodes. Lastly, Allan Gray is an authorized FSP. To view our terms and conditions, please visit allangray.co.za. Until next time, I am Vuyo Mkhotliso. Thank you for listening. This podcast was produced by Volume Podcasts.
There's a song that goes, "Money can't buy me love." And that's true. But then they told us all you need is love, which anybody with a mortgage will tell you most certainly is not true. Love won't pay your parking tickets or your student loan. It's also needy. It requires effort, availability, constant care. But more importantly, love requires time. And while money can't buy you love, it can certainly free up some of your time. Time to spend on the things you love, with the people you love. And if you're looking, maybe even time to find the one you love. That's why, after 50 years of investing, we've learned that time is the greatest gift of all. And the good news is, if you invest early, time gives you money. And then money gives you more time to do the things you love. And don't you love that about investing? Ellen Gray, long-term investing. Ellen Gray is an authorized FSP.